Many well-known large-cap Chinese stocks have bounced off their recent lows. Alibaba up nearly 29%, Tencent Holdings up over 23%, JD.com up over 43%, and Baidu up over 38.5%. Are those moves likely to continue? How are some institutional options traders playing it? We'll take a look tonight on Open Interest. Hello everybody and welcome. My apologies that I haven't been providing these web extras of late. Unfortunately, the reality of having kids in school is that kids get exposed to the latest variants of the coronavirus, and then they come home and expose the parents. Happily, as of today, the kids are both returned to school and the household is on the mend. Also recovering lately have been Chinese stocks. Big names such as Alibaba have rallied sharply off recent lows. But is this just a bear market rally, or does this most recent bounce have legs? Several of the biggest Chinese names saw big bounces today. Baidu was up nearly 2.5%, while Baba was up over 6%. The options in both these names were busy. Alibaba traded over 207,000 calls versus a 20-day average call volume of about 131,000. Baidu traded about 30% above average call volume as well. But there was also well above average activity in FXI, the iShares China Large Cap ETF, which traded over 2 times the average daily call volume. And the largest trade was a purchase of 80,000 of the July 36 calls for 42.5 cents. Now, how did it get to 42.5 cents? They traded in 2 blocks. 40,000 traded for 42 cents and 40,000 traded for 43. We say that's trading on splits. Those 2 trades printed about 3 seconds apart. The holder of those calls has the right to purchase 8 million shares of FXI at $36 a share on or before July expiration, risking about $3.4 million in premium for the right to purchase just under $290 million worth of FXI. FXI would need to rally over 11.2% from today's 32.75 closing price for those options to be profitable. The options market right now is implying about a 1 in 5 chance that that happens, but it's worth noting that FXI remains over 30% below its 52-week high of 47.22 and is nearly 40% below the February 2021 peak of just under 54.5. After Chinese stocks were hard hit by Chinese crackdowns, what fueled the bounce? The state-run Xinhua news agency reported the Chinese government continues to support various types of companies to list overseas, and also stated that it will strengthen communication and cooperation concerning the stability of Hong Kong's financial markets. This also supported KWeb, the CraneShares CSI China Internet Fund, which traded over 2 times average daily call volume as well. And here too, options traders were looking out to July, including big purchases of the July 32.35 call spread for just under $1.10. This bet requiring a more modest 8% move by July to see profits. So who might be doing these trades? Some of the biggest holders are, unsurprisingly, broker-dealers and volatility-related hedge funds who essentially operate as market makers. But there are also some names that appear to be betting on a rebound. CI Investments held 45,000 calls in FXI according to their most recent 13F. Exodus Point Capital Management and Rocos Capital both reported holding 25,000 calls in FXI. Boundary Creek Advisors 20,500. Steadfast, Tudor, Ibex, Cube Research, Point72, and Brevin Howard are also among prominent holders of calls in FXI per their most recent 13Fs. Now, the bull case for the Chinese stocks is 1, they're cheap. Baba, for example, is trading just over 14 times earnings, even net of today's 6+% pop. 2, these are marquee halo names for China. And if they're done reining in prominent founders like Jack Ma, perhaps the government will actually let these companies thrive. The bear case is naturally that the Chinese government is mercurial and capricious. The risk they pose is both real and has to introduce a discount to Chinese stocks. Also, the Chinese economy has been stifled by shutdowns, and credit risks, of which there are many there, can metastasize. Finally, the global decline in equity prices may not yet be over. Another risk-off phase, and likely all stocks globally, could see further downside. That said, size appropriately, speculating on a bounce in some of the most damaged names may make sense, as even bear market rallies can present short-term opportunities to the upside. I'm inclined to put small money to work with the bulls on this one. If you enjoy the content, do me a favor, like and subscribe, and I'll see you in the next one. Thanks for watching.